The Mayberry Virtual Investor Forum, Investing in Jamaica.
Good evening again, ladies and gentlemen. Welcome to our follow-up virtual investor forum. As usual, I'm your host, Dan Theok, Senior Vice President of Investment Banking. And here we're now looking at the Mayberry Group Limited results for Q3, just having wrapped up our look at the Q3 results for SVL. Well, let's get on to it. Joining us on the panel is our Executive Chairman again, Christopher Berry. Welcome, Mr. Berry. Also online, we have Group CEO Gary Parrott. Welcome, Gary.
Hi, guys. Good afternoon.
And joining us today also, we have Patrick Battier, our CEO of Mayberry Investments Limited. Welcome again, Patrick. Good to have you here. Well, folks, you know the drill. If you're a fan of the content, please subscribe to stay updated with our uploads and be sure to hit the like bell to receive all future notifications as we publish videos just like this just about every week. Don't forget to stick around for our Q&A segment at the end of the program. You can submit your questions and we'll address those in our live chat. If you're looking to embark on your very first investment journey, please take that first step with Mayberry Investments Limited and follow us on our social media pages today so you can get started. Okay, we want to jump right into the MGL discussion and presentation. We're going to look at the results for the 9-month period ended September 24. And first up, just big highlights. I want to look at the fact that our total shareholders' equity is at $15.9 billion. That's a 2% decline from December 23, which was $16.2 billion. The year-to-date loss attributable to shareholders improved by 19%. We had a loss of $693 million before. That's down to $561 million. And we'll talk about that, driven primarily by our unrealized gains and adjustments to the value of our stock portfolio coming mainly through our subsidiary MGL, but we'll dive into that. Total comprehensive income, that loss also reduced by 92%. We had a $1.7 billion loss last year. That's down to $129 million. Total assets actually up by 5% to $61.7 billion. And our net book value per share down by 2% from $13.51 at December 2023 when we closed out our audited financial statements. In the last 9 months, that shrunk by 2% to $13.2 per share, again driven primarily by the retraction in the values of our equities on the stock market. Next slide, when we jump into the actual presentation of the results for the 9 months, you can see that net interest income, at least on that line item, we made significant improvements year to date, $1.2 billion net interest income compared to an actual loss net interest expense of $1.1 billion same period last time. So you can see we've adjusted our spreads after facing increases in interest rates, brought that aspect of the business under control and back in a healthy position in terms of making a spread on our net interest expense. Operating expenses, that was up from $1.5 billion to $1.78 billion. So that's up by about 18%. We'll be discussing that with CEO Parrott to understand what's happening there. And the result of having net interest income of $1.2 billion, but having operating expenses of $1.7 billion, is that we had an operating loss for the period of $538 million, still substantially better than last year when we had a $2.6 billion loss. And again, most of these losses that we're facing are unrealized. They're associated with actual marking to market of our investments that we're holding, and in many cases the high interest rate regime or environment rates typically result in lower PEs and lower stock price values, and we'll talk a little bit more about that. Net, we had net profit $561 million, 19% improvement over the sales to a $224 million total comprehensive income because we had net comprehensive gains of approximately $300 million. So we end the year with $224 million of OCI compared to $682 the year before. In the quarter itself, you can see just for the quarter that we actually had a $98.8 billion OCI for the quarter. So substantial improvement experienced in the quarter, but year to date, because of the big loss we had in the first and second quarter, we haven't been able to turn that around as yet. Going to the next slide, we look at sort of total assets. We talked about this, and total equity attributable to shareholders, that fell by 2% from 16.2 billion to 15.8 billion, while total fell by 1.1% from 24.8 billion to 24.5 billion. So the difference between the two being the minority interest subsidiary of MIL, or MGL, I should say, Mayberry Group Limited, and that minority interest is the difference between why we have total equity of $24.5 billion, but total equity attributable to shareholders of $15.9 billion, which we've pretty much covered versus the small shrink in shareholders' equity. Next slide shows this in sort of a graphical format, what's happening with total assets. You can see 0.9 to 61 billion versus what's happening with total liabilities, going from 33 billion to 37 billion, versus what's happening with total equity, which was roughly flat compared to the same period last year. So difference here between the first slide with the numbers was December to now, whilst this slide is showing comparison to Q3 2024 to Q3 2023. Next slide shows the movement in net book value over a longer timeline using Q3 of each of the last 4 years as a reference point. You can see that this has grown from 1378 when it peaked, and then now it's sort of fallen down for the last 2 years as over the last 2 years during this high interest rate regime have been somewhat depressed. We're seeing lots of stocks carrying 5-year lows, all-time lows, 5-year low, for instance, for NCB, certainly 5-year low for SVL, and for quite a few other stocks in the portfolio. But fundamentally, we still have a very good basket of equities in our portfolio. And as interest rates trend down, which is happening now, we've seen the 30-day rates, the 1-year rates, the 180-day rates, the overnight call rates all coming down. In the case of the 30-day rate, we've seen the largest fall. That's fallen from about 10% to actually 11.2% was the peak rate for 30-day CDs. We have an auction every single week. For those of you who don't, money's invested in 30-day CDs. It's about 130 billion Jamaican dollars. We've seen those rates coming down every week, just about every week for the last 10 weeks, now into the 7% interest rate region, just under 7%. And that's definitely sending a signal to folks who have gotten lazy and parked their money on GOJ treasuries, haven't decided whether equities are coming back. They've been sitting there. Those interest rates are now low enough that they're barely keeping ahead of inflation. Inflation's at about 6%, roughly speaking. And so we expect to see folks shifting asset class investments, moving away from fixed income, certainly GOJ treasuries, and moving more into equities or corporate notes where they can earn better interest rates, certainly much better than 7%. So for instance, had you bond, you could be earning 10, 11%. Had you invested in the MIL bond, you could be earning 10 or 11%. And for accredited investors, there's a dollar bond out there now that pays 12%. So still not too late to get yourself some of the dollar corporate notes that's paying interest rate at 12%. It's a secured corporate note issued by Dollar Financial Services Limited, a company that's done exceptionally well on the junior stock market over the last 2 years, and they're raising more capital to further grow their loan book. Next slide shows the movement in the stock price history of MGL, which has been relatively flat in the $8 space. It goes up and down from time to time, but relatively flat, pretty much at $8. Next slide shows the history of the MIL stock since we listed, and more importantly, the dividends that have been paid. So it's one thing to have the stock at $8. It's another thing to be consistently receiving a certain level of dividends. 30 cumulative effect of the dividends that have been paid over the last 17 years, over $4.3 billion in stocks paid, $4.3 billion in dividends paid, I beg your pardon. And to boot, there was also some MJ stocks that were paid in lieu of dividends that happened when MJE went public. I don't think that's captured here, but it's a great slide that shows you the substantial level of dividends that MGL now, I beg your pardon, MIL has sort of reshuffled the group, and now MGL, Mayberry Group Limited, is the parent company that sits on top of the group. It's the unregulated arm of the business that then owns MJE, MIL as a 100% subsidiary, and subsidiary that handles our private equity investments. MIL, Mayberry Investment Limited, is the regulated business within the group that's regulated by BOJ, FSC. That's where we do our investment banking business, our Cambio business, etc. And so we're here talking about the result limited, which includes those three subsidiaries, as I mentioned, with MJE being an approximately like 52% subsidiary, which creates the minority interest that I mentioned previously, while the other 100% owned subsidiaries. So just a little background about MGL. Next slide shows pictorially or in a graph what's been happening with those dividends and the cumulative effect of those dividends on the stock price over the years compared to the net book value per share. And you can see how that's been growing steadily over the years. So for those who will say, hey, I bought the stock at $5 and it hasn't grown by much, it's up by, say, 60%, you can't ignore the good return over the period. And they look to be a company that's going to continue paying a health. And so that's my quick review of the financial results. So in general, just to summarize, we see a turning of the interest rates coming for Mayberry, and we expect to see its profitability increasing as interest rates trend down. It gives the business the ability to raise capital at lower rates, to increase its spreads on its loan book, and so it has invested in through MGE. We would expect to see the value of those equities increasing substantially. Jump into a few questions. I will attend to your questions online. So I want to encourage you guys, for those who are watching online, if you have any questions, feel free to send in those questions as soon as I see them. So, Mr. Peart, first usual general questions. What's going on? So we see Mayberry Investments with over $300 million loss approximately. Could you please, explain that to us in a nutshell on losses, large transactions you did there, and stuff like that to bring some comfort to people's minds?
Quarter. We made a really good profit this quarter, which I think a lot of people should focus on, because the stock trades at a discount. I think it's one of the cheapest stocks in the market, right?
Mm-hmm.
And people historically say that we can't realize full value for the assets when we sell them. But once again with CPJ, we've demonstrated that we not got a premium from the sale of CPJ. And one of the beautiful things about the sale of CPJ, it crystallizes the unrealized gain cash where that's concerned. So that is one of the big drivers for the profitable quarter. It wasn't big enough to last to 6 months, which was, materially more, which was materially larger than what it is here. And the trend, which we'll speak to her later, suggests that, we may very well end the year with a nice profit as well. In terms if certain liquidity events occur in other companies in the group. So one of the things that you should see, for example, is the sale of CPJ brought in cash. So you would expect to see one of our main subsidiaries, MGE, the only stock you need to own. The interest expense on MGE should start to fall because a lot of that cash was used to repay debt that MGE had. Quite a bit of it was used to repay debt that MGE had. So that will materially reduce interest expense on that side. In terms of Mayberry Group, there's more capital. And that's why when you ask us are not comfortable, 15.9 billion Jamaican dollars in shareholders' equity is 100 million US, as 100 million US in shareholders' equity. So it's very strong, and it is strong after you've seen this. So where are we today? You've now had 2 successive rate decreases from the central bank in the signal rate. We expect there to be mood out there, as interest rates start to trend lower. It's always a positive thing for the stock market. As I said in one of the briefings for MJ earlier, the only stock you need to own. We have taken the time to start to reload certain value stocks. So, from our MJ perspective, Guardian, NCB, etc., we expect the shares in those companies to come good at the very least by mid-year 2025, if not before. So the stage is set for a much better 25. Last quarter, we think based on what we're seeing out there, we should eke out some more gains, and the expectation break even and have a small profit for the end of 2024.
15% increase in operating costs to $1.7 billion. A little bit about that and your strategies to contain costs going forward.
Well, as you know, Dan, and the rest of the investors should know, we have spent a lot of money over the last 3 years developing software, so making that digital switch to ultimately full automation. Ultimately, you're investing to get the efficiencies, but at the same time, in owning the technology, you're going to have to depreciate it. So what you have is that as the technology is developed and we've rolled it out, you have the depreciation cost that we now have to start to account for. So you would see that OpEx of the depreciation is start to trend higher. But what should assist it is everybody gets more comfortable with the software changes. You would expect to see a reduction in other costs to give you that return you expect on your investment.
Good deal. And trend down and general changes. How's that going to impact your strategy going forward, do you think?
Positively. The Mayberry Group is set up in a way where, we will make money whether in rising interest rates are low. So we, within our private equity business, as you know, we have a material real estate project that we're doing at Chalmers. We're finished to rent the building now. So you have a stream of flows that's going to come there. So once you've tenanted it, you get a stream of cash flows until somebody comes and with lower which I'll turn over to you as investment banking, as to what your view is on the problem. You understand all of that in the pipeline. So lower interest rates drives that, and ultimately, where the majority of the group's equity is invested is in the stock market, and lower interest rates will drive a material movement in the stock market. Certainly, if not to the back end of this year, certainly by the middle of next year. And I think we're pretty well poised to benefit significantly from that. So, if interest rates continues going lower, we'll make some. Where it is here, we'll make some good money. Because there's still significant demand for our margin products, primarily, supporting margin supported by equity or shares on the stock market. And then also, which is one of the reasons, Patrick Bataille is here with us. Signature focus now is on building funds under management, which is technically a risk-free way to grow your business whilst earning material income. We deliberately have designed and developed the software to allow us to be very competitive in that space. So in addition to Patrick's experience in all of those key areas, digital operations, acquiring customers, etc., we expect to see good gains from that.
Great. And Patrick, I do want to personally welcome you on well together for the last month or two, and it's great to see you expanding into that role. I mean, you've seen these, I think Jamaica's like the poster. I mean, what are some of your own expectations as you come to the team, over the next year or two, as you sort of take over the seat? We have the passing of the baton to an extent from Jeremy.
I'm really looking to diversify. I was working closely with you, Dan, around footprint.
Pleasure to be working, into that boat,